Hello, everyone. My name is Kamal Manocha. I represent PMS AIF World. Taking the rhythm of Friday webinars ahead, we have another webinar planned on this Friday. Before I begin, I will wish once again to all our viewers very happy Diwali and happy New Year. So for this particular webinar, we thought of kind of inviting Mr. Vikram Gupta, who we have been connected with for almost 1 year. Vikram, is our speaker today, and Vikram is a managing director and founder of IvyCap Ventures. He is one of the early minds when the VC space was taking birth in India, and that is where we thought of doing this thought leader webinar on this Friday evening with Vikram to learn the genesis and the current status and the expected future of the VC space. We at PMS AIF World have been deep diving funds in the space of alternatives very, very keenly. And we have a very, I would say, in-depth understanding of who are the people behind all these funds and what drives performance. So we always want our clients to make right choice. And that's what we are wanting to actually do at a big level in the space of VC and PE spectrum. And obviously, like you guys will be equally keen to learn with our webinars, and you have always shown us support. We are also kind of equally keen to learn. And this is not a product discussion. This is a discussion to understand various aspects of the VC space. And obviously, we'll be covering the most important aspects: how to identify, the next unicorn. What are the criteria that somebody who has done that in the past successfully follows that now over say next 10 years, because the juncture, the overall, I would say, the discovery of unicorns absolutely has been happening, and I think the landscape is changing, the industries are changing, the types are changing. There have been a lot of learnings which many fund managers have had over the last 1 decade. Welcome, Vikram, to this webinar, and you can maybe begin by giving your background and your story. And obviously, we are keen to understand from you what is the history of VC space in India, because you are one of the early minds. When you began, how was the landscape and how it has been changing over times? Let's maybe start with that, and then we'll deep dive further.
Thank you, Kamal, for having me for this program. So I really appreciate this. So let me start briefly with what we are doing and what my view of the history of this is. In fact, I started investing through private equity, venture capital. In fact, the first fund I set up was a private equity fund, which is, again, all domestic capital in the year 2008. After the crash, you might remember there was a crash in 2008. I raised about 400 crores, all domestic capital. This was primarily Indian institutional capital, with about 30 plus Indian institutions were invested in that fund, which I raised between 2008 and 9, and then invested that between 9 and 10. And then in 2011, I set up IvyCap Ventures with a very interesting philosophy, which was a people-focused philosophy, basically identifying a specific target set of people, which is basically IIT alumni, with the whole intent that, it's all about investing in the right teams. It's all about execution. India's story has been intact right from early days, and it continues to be very strong. So we continue to believe that it's all about people focus. 2008 onwards, I have seen this market from very close, being part of this ecosystem. And I've seen multiple phases of evolution of venture capital, private equity in India. I would say that there was a pre-2013 era. Then there was a 2013 to 2016 era. And then there was 2016 to 2020 when COVID started. And then there's a post-COVID era. So basically, I would break it down as per these timeframes. Pre-2013, there were hardly any VC funds in India, and any funds that you would see would mostly be only primarily dollar funds, and a few government started funds like SIDBI was still there, and a few other state government funds were there, which were actually running at that time. But 2000, I think, 8 time frame, you would have seen a few corporate-backed private equity funds that had emerged at that time, with the Tatas of the world, Birlas of the world, and also Reliance and Piramal Group and a few others who'd actually set up corporate-backed private equity funds. And 2010, 11, 12, we saw VC funds started building up. In fact, around the time when IvyCap was started, we had about 6 or 7 other domestic VC funds that started at the same time. Interestingly, all these actually came from the Mumbai Angels kind of backgrounds. So they were coming from the angel side. And that is the starting point, I would say, when the domestic venture capital funds started building up. Of course, there were Sequoias and Accels and a few others who were operating, pure dollar capital at that time as well. In fact, Accel entered the market a few years before that by acquiring a team which was running another fund called Erasmus. Sequoia entered the market by acquiring Westbridge Capital. And then a few others were trying to establish in a similar manner. Between 2013 and 16, I think some growth started happening. But in 2016, the government of India announced a startup policy, and they started registering startups on the DPIIT platform and started calling this as a sector of immense importance. And that was a time when the government started playing a very active role in promoting the startup ecosystem and actually allocating funds through different pockets. SIDBI got a lot more funds through different programs, and a few other investors started coming into the market. We saw emergence of HNIs, we saw emergence of family offices around that time, and I think, of course, the startups started getting a lot of boost. 2020 onwards, we saw a sudden shift in the market, primarily because of COVID. There was an acceleration of the digital world. We saw a lot more, impetus to startups which are completely driven by digital acceleration. And therefore, we also noticed that because of the printing of the US dollar, more than $3.5 trillion that got printed just in 1 year, it had an impact on 2021, when the highest amount of funding actually came into the Indian startup ecosystem, because a lot of this money that was printed in the US actually found its way to the startup ecosystem in India. And therefore, 2021 was a period when which saw the highest number of unicorns. We saw 44 unicorns in a single year. So, of course, that had its own impact. There was so much liquidity in the market, which led to a huge amount of inflation in 2022. We saw that led to failure of banks like SVB, primarily because the US Fed increased the interest rates in a very short span of time from 0 to 5%. That led to dollar money again getting pulled back, because why would anybody want to take dollar risk when they're getting 5% in their own respective banks in the US? There's less appetite to take exchange rate risk. Therefore, there was a huge kind of liquidity crunch all of a sudden. I think it's important to note that the overall dollar to rupee ratio in the Indian startup ecosystem, while it has grown over time, it is still only 15% domestic capital in the startup ecosystem. And we talk about over $100 billion, which has been invested in the startup ecosystem over time. And now, in the last, I would say, 6 years or so, we've seen substantial exits in the startup market. In fact, one of the biggest concerns that investors had was the money goes only in one direction, doesn't come back. We saw a huge kind of a change of mindsets with the loss-making startups actually going IPO in 2021, which actually gave a flavor of this kind of investments to various class of investors. Of course, that went down substantially in 2022, but now having seen that experience, at least investors know what startups can deliver. We are seeing now 2023, the markets are coming back, while they're still slow in coming back. The quality of startups hasn't changed. The growth story of India has stayed intact. The overall fundamentals have remained the same. It's just that the liquidity has changed quite substantially over time. We at IvyCap, in fact, have been very fortunate when the market was really very liquid. We got some very high quality exits. We took money off the table in 2021. We didn't make, in fact, any investment in 2021 except for those which were already committed in 2020. And 2022, when the market started going down, when people thought that's a bad time to make investments, we at IvyCap were actually, we started making active investments. In fact, the last 12 months, we've already deployed 500 crores from our fund 3, which is 2,000 crore in size. And we've actually were very fortunate to make this entry point at a very, very decent valuations. I mean, these are the same entrepreneurs with the same business models, and their models haven't changed. The foundation hasn't changed. It's just that the entry point changed for us. And of course, in a 10-year cycle, which is the cycle for a typical fund, you will see a bad cycle and you will see a good cycle. If you're investing at the bad cycle and exiting in a good cycle, that's an ideal combination for a VC fund to operate. So I think over time now, at our times, I mentioned about 6 to 7 VC funds that have started emerging. Today, there are about 1,300 registered venture capital, not just venture capital fund, but AIFs with the SEBI. Of course, that doesn't mean all of them are very active. I think half of them almost came in the last 3 years or so. Majority of them actually still raising their first fund. And, if people started raising their funds in 2022, they are still not finding it easy to go beyond their first close or, raising 1/3 of their capital. Because of the large number of funds in the market, investors are also now flooded with lots of such opportunities. We are seeing a substantial kind of build-up of opportunities for angel investors over time. There are multiple kinds of angel groups that we've seen emerging. On one side, we've seen national level angel networks like Indian Angels Network, others are there. And then there are localized angel networks like, Chennai Angels, Hyderabad Angels, Rajasthan Angels kind of people that have emerged. And then there are, people driven by specific groups which have set up angel networks, like there was CXO, like a CFO Angels and many other angels, which is a good thing for the startups because now they have multiple avenues of fundraising. But at the same time, it has had an impact on the ecosystem from the perspective that a lot of inexperienced investors also entered the market and started putting value or a valuation of the startups from a different perspective without much experience. And many startups even got killed only because they got funding from inexperienced people where the terms were so draconian or so different or so non-long-term aligned terms. That's why the failure rate also has been quite high. But that's very natural in the evolution process. I think it's a learning curve any startup ecosystem will go through. Good news is that we are seeing now investors who've gained a lot of experience in the current market. We are seeing a lot of family offices being set up basically to invest in this space. We are seeing people building up their own portfolios. It's all good thing for the country. We are the third largest startup nation in the world. We're also the third largest country in terms of the number of unicorns, or the number of unicorns that ever became unicorns. We're talking about 111 unicorns. And our projection is going forward that in the next 7 to 8 years, given the fact that India is projected to be the third largest economy, in the next 7 to 10 years, we are projecting another 500 unicorns during that time frame. And our philosophy actually continues with that model where we are focused on operating through the IIT alumni platform. We believe that, out of the, since the percentage unicorns is the highest in that background of people, out of 111 unicorns, 73 unicorns have founders with at least one founder with the IIT background. And imagine with the next 500, even if you have a similar ratio, it kind of offers a very unique advantage when your whole thesis is going around that model. So that is a little long answer to your question, but I thought maybe it's important to set a context, historical context over time.
No, sure, absolutely, Vikram. This is very insightful and very interesting answer. So let's move on to the subsequent, part of this discussion. What is the lens that you have evolved over time, through which you actually will see the future unicorn? You mentioned that you have been investing in people, which is one aspect that you have covered. Now, what type of people, and then what beyond people, and in current context of whatever learnings you have had over years, where I'm sure there would have been some bad decisions also through which you would have learned. So now onwards, if you in IvyCap are you wanting to identify future unicorns, what is that lens, and where do they lie?
So, Kamal, I think our philosophy hasn't changed over time, and I think there are two, three very important things that we look at from an overall perspective. One is the lens of the sector we're going after, and we've seen that sectors and subsectors, are at different stages of evolution. There was a time when all the consumer platforms, were actually the right time to get in at a Series A level. It was a perfect time to get into a purple kind of a platform in 2015 when we invested 15 crores for a 30% stake. If you try to invest in a beauty and personal care platform today, you may not find an opportunity at Series A, right? So each sector and subsector offer a unique opportunity in its evolution phase, right? Each sector has its evolution phase. But there are opportunities, for example, if you're looking from a Series A perspective, if you're looking at consumer, for example, you will see opportunities which are building up in very unique models where people are either aggregating certain brands or identifying products which can be taken to tier 2, tier 3 towns, or products which are emerging from rural markets and can actually be also sold to rural India. So there are actually multiple kinds of opportunities that emerge when it comes to consumer. Similarly, in financial services and fintech, we've seen again another kind of evolution. We've seen a lot of lending models, in different areas emerge over time. These sectors are so large that, even today we are still scratching the surface. Even on the consumer side, we've seen the digitization actually penetrating into the market, starting with just 1 or 2% now, going up to, close to double-digit numbers very soon. It's still 90% of the market is still not fully penetrated, right? So which is actually still happening over time. So which are all high opportunity areas. So each of the sectors, you do a top down and actually try and understand what are the areas which have already been addressed and the areas which have not been addressed yet. We believe that areas like healthcare, areas like B2B SaaS opportunities applied across different verticals. Generative AI is now a new buzz, which is actually starting to impact almost every sector. From a tech perspective, we are seeing opportunities across different areas, which is disrupting, for example, any IoT technology coupled with AI, wherever the things are highly process driven, systems driven, compliance driven. Those things don't need too much of manual intervention. They actually can be done using technology. We've done an investment from Fund 3 already in a company called Zest IoT, which is actually automating airports. From the time a plane lands to the time it takes off, there's about 60-point manual checks, which can all be automated. And this company has already done 6 or 7 international airports, which are already using their platform to automate these things, which is like improves the quality of the overall operations and improves the safety aspects. So you will see technologies like these actually substantially changing the way things are done. So that's a top-down approach that we use, to kind of identify gaps and areas which are still not addressed. And then we use a bottoms-up approach where we say, let's look at the teams and let's understand their passion. Let's understand why they're doing what they're doing. There's a what part, there is a how part, but the most important part we look for is the why part. Why means, why, what is driving you, what you're trying, why you're solving this problem, why you think you are the best position to solve this problem. If there is a passion driving you, are you going to sustain a time when the things are going bad? Because when things are going well, everybody's happy. The real test of the real conviction is when things start going bad, and things go multiple times bad. So these are the kinds of things that we evaluate. So of course, and some of the things, especially the reason why we go after the IIT alumni, and that's 60% of our portfolio today, is because a substantial part of these things are tested already when they're actually gone through a JEE exam, in terms of their overall planning, focus, discipline, hard work, conviction, and their execution aspects. They're all tested already. The things which are not tested fully are the teamwork, how they build their teams, the ability to raise funds, the ability to stay put, ability to understand their competition, and ability to fight against the competition. These are the things that we want to test out fully when we are talking to them. That's why we track them over a period of time. And of course, eventually, when we start working with them, we also look at the fact that, are they willing to work together with the VC fund who also wants to bring value and add value. If we can't add value to a startup, we don't think it is worth our time. And finally, because we are a VC fund, we are very exit driven. We want to see that in a 5 to 6 year time frame, we are able to sell our stake. And we look at the lens of an M&A in a 5 to 6 year period, which means that does it meet two criteria? Number one, does it reach a size which becomes attractive enough for somebody to buy? And number two, does it have enough differentiation at that time for somebody to pay a premium on valuation? So as long as we've validated on this, on all these fronts, it becomes the right startup for us. We are not a spray and pray investor. Even with the 2,000 crore fund size, we are looking at 25 new investments, which is an average of 50 crore Series A bet. And we believe that's the right approach, because we want to really work very collaboratively with them to help them scale their businesses. So that's the philosophy that we work on.
Vikram, this is quite, I would say, interesting. I think, if I see myself as an entrepreneur, I am really kind of, seeing a lot of value in this conversation, because it is kind of a lot confidence enhancing. I see that you actually, understand how to evaluate the life, thought, vision of an entrepreneur. Absolutely, which is like very good. Subsequently, I want to ask this question from investors' point of view. There are a lot of ultra HNI investors and HNI investors in our database who might be watching you now, or who might watch this video once we'll upload this. So many of these clients have this idea of having the in-house teams and then investing directly in some of these companies, and they would want to, even while evaluating the fund, want to know whether they will get a co-investor opportunity or not. And that is one element which drives them always, because as a successful businessman, when one is kind of has made money through one's own enterprise, when he's trying to invest in some other enterprise, one maybe tries to put oneself as a fund manager and creates a portfolio. But practically, I have seen such clients have actually made mistakes, and they actually make less returns than funds like yours. But still that continues. Still I see a lot of money gets invested through family offices in that route. What is your answer to those ultra HNI clients, and have you also come across such thing in the past, and how would you want to address that?
No, you're absolutely right. And this is a part of natural evolution process, which I was talking about earlier. So let's kind of dissect this a little bit, right? I mean, imagine that if I'm a HNI, ultra HNI, I'm sitting on my own capital, in today's market with 100,000 registered DPIT startups and growing month on month, right? In terms of the number of startups, wherever I'm sitting, especially if I'm sitting in one of the metros, now even in tier two towns, I will have access to a few startups in my network. That's always going to be the case, right? So even if I have access to 10 to 15 startups, I would assume that I already have access to startups, right? So that's the first feel that you get, that, and if you form a network of a few people who come together and you think that you've created a network which is good enough, 10 people get together and everybody has access to 10 to 15 startups at least, put together you have access to about 100 to 200 startups anyways. And that gives you that feel that, what's happening in the startup ecosystem. You can create your own deals, you can build your own portfolio. And if you're a part of the group which is also a little experienced, done investments earlier and maybe even done some exits, it kind of gives you overall comfort and feel good that you can do it. And I think nothing wrong in that. It's just that, you know typically the access that you have is about 200 to startups out of about 100,000 startups in the ecosystem, right? So what you don't realize is that, if you have access to a smaller set of startups, you may not have looked at, when you look at one particular startup, you also need to know that, there are, for every company in a good space which is solving a problem which needs to be solved, there'll be at least 20 other startups that may have also started around the same time or maybe ahead of the curve. Some of them obviously would have started even raising funds. And this is actually a full-time job. If you're doing this as a full-time job, you'll be tracking specific sectors. When what I talked about as a top down, we have a team of 40 people, and we have a specific research team whose only job is to make sure that when we look at the top down, we are evaluating every startup in that top down. We look at which are the startups that got funded. We would have met those entrepreneurs at some stage, or if you've not met them, we'll make sure we meet them, understand the teams. We understand where their minds are in terms of capital efficiency, what kind of scale they can build, how the team building skills are. So we ask lots of questions before we actually finally invest in them, and all these questions are typically asked over a period of minimum 1 year. In certain cases, we've actually chased tracked them almost for 5 years before we finally decided to invest in them. So that's actually more than a full-time job. If somebody is willing to do that, that HNIs and ultra HNIs as a full-time, that's great. If they can't do it full-time, then from my perspective, it's pretty much like buying a lottery ticket, which is very exciting. I mean, you see people who enjoy actually playing lotteries as well. But sometimes they also enjoy this whole glamour attached to this investing, which is actually obviously they want to be part of the whole kind of interacting with these founders. And sometimes it feels really great that you actually mentored someone that became a Nika, or that became a Policy Bazaar, or that became a delivery. And if you actually were part of the initial discussions with them, and it's a very exciting discussion that, oh, I met the founder, I missed the deal, and then, oh, I met the founder, I put 5 lakh rupees, and that 5 lakh has become 5 crores over time. So I think these are all very exciting things that happen. And when you see somebody in the network actually doing it, and you start believing even more that if somebody else has done it, you can also do it. But what people don't realize is that, when you go deeper, try and understand a little deeper, even those people, maybe would have got purely lucky. When this, of course, luck plays role everywhere, even in a VC model. Even for us, even after doing full time, luck plays a huge role, right? Even after analyzing a large number of startups, we have, as you rightly asked the question, have we failed? We have failed, and we have lost deals which would have become unicorns at early stages. And this, we call it type 1, type 2 errors. We made type 1 errors where we rejected deals we should not have, and type 2 errors where we invested in certain companies that probably should not have been invested in retrospect. Even though type 2 errors, and both these type 1, type 2 errors, when you go back in history, in our case, every time we ask the question, would we have changed our investment philosophy, our investment approach, our overall mindset? The answer is no, we would not have. Yes, we were at different stage of our evolution ourselves. We were a smaller fund at that time. We were taking lesser risk at that time. And in certain cases where we failed, we made certain hypotheses. Out of 10 companies in fund one that we invested in, we failed in one, where our hypothesis was that the smartphone penetration will happen much faster amongst the farmer community. It was about giving personalized information to farmers on their cell phones. At one point, we were dealing with 50 lakh farmers on our platform. It was still an SMS world, which was very expensive. And all of a sudden, TRA had decided to increase the SMS pricing 10 times. Our model became unviable. So would I have decided to not invest in the company if I had known that information at that time of future? Maybe not, but I didn't know that information at that time. So really, it was a good bet at the time of investing. Similarly, in Fund 2, out of 23 investments, we lost 3 companies, 2 because of COVID and 1 because of, the company became a capital intensive model later on. But all 3 investments put together in Fund 2 was 5.5% of the total fund size. So that way, we've been very fortunate that it's not, our failure rate is not 90%, which you would typically see. In fact, the actual failure rate will be 97%. And in the VC world, typically you will see people quote data about 50% of your portfolio will go bust. Another 20% will give you average returns. Another 20% will give you super normal returns. And one deal or 10% of your deals might give you out of the park kind of returns, and which give you returns on the entire fund. So that's typically the ratio. But in our case, out of 10 companies, we had 3 companies which actually were almost like out of the park kind of deals. And there were another 2 which were actually very good returns. We just failed in one. And I think it's about your investment strategy. And I'm not saying that, a spray and pray approach is bad or wrong. I've seen people investing in 300 startups over time, building a platform where, you put 111 crore over time, or even 50 lakhs, 25 lakhs over time. And then you realize that out of that 300 companies, 50 started showing good value and 3 became unicorn. So it's quite possible, but if you just put in 50 lakhs in a company which has become unicorn, you actually put 1 crore in 300 companies, or 300 crore you deployed, you still may not return your entire fund, because, eventually, your strategy has to be how much money you're actually returning or generating in your overall investment. In a fund 1, on a 240 crore deployment, we've already returned in cash 620 crores back to our investors, and returning another 150 crores or so roughly. Another in fund 2, we've already returned 40% of the principal in cash back. Fund 1, we did create we use the term dragon more often than unicorn, because dragon is actual cash returns, which talks about, Dragon is a company which gives you more than 1x cash return of the entire fund. Purple became our dragon in a fund 1 portfolio, which actually became India's first dragon in an Indian VC portfolio. We invested 15 crore in the company in a 240 crore size fund, where we got 330 crore in cash when we exited in 2021. We are now building a second dragon in fund 1, which is Bluestone. And we are expecting 4 dragons in our fund 2. So our philosophy is all about, whenever we look at a company, the first question we ask is, can this company become a dragon? Which means that can this company, or does this company has the potential to return the entire fund in cash? So that's the kind of evaluation we do. And therefore, you'll see a very different approach between a VC and a HNI investing through their separate platform and doing direct investments. Sometimes people will do direct investments also because they see more strategic value to their other core business. For example, if I'm a business in healthcare life sciences, I may want to do direct deals because I do get to see startups, for example, as a customer, or in other ways through my supply chain. That's exactly what I did when I was Ajay Piramal. I set up India's first healthcare life sciences fund. Part of the deal sourcing strategy was to actually look at those startups which are actually through the entire value chain. It's a good strategy to look at the startups that can come through your value chain, but then you have to do it again full time. You have to put a team together, which actually does nothing else but sourcing startups who actually have some focus strategy. But if you're doing it as a part time, by kind of assuming that you will be able to get these deals and eventually somebody else will help you exits and all that, it doesn't really happen, because decisions have to be taken at the right time. Timing of decisions is very important, and you can only time your decisions if you're actively involved. So my only advice to people who are actually doing this directly, unless you're absolutely sure that this is an investment that you'll have a control on in terms of your investment, just ask these questions to yourself. Whether you're taking a bet as a more like a gambling bet, or is it something that it's your hunches that you can make money, or have you done all your analysis? Have you asked all the questions that need to be asked before making that investment? So these are some of the things that I think are important from investing perspective.
Sure, Vikram. Another question, which when I put, myself in other founders' shoe, would want to understand from you. Let's try to understand from the kind of investor's perspective. It's like the companies that in which you are likely to invest. What is the value add that a fund like yours add to a fund, add to I would say company, or when a company is kind of wanting to think of diluting and adding you as potential investor? What is the value add that you propose to that company, and how do you convince that, and what is, and if you can maybe take an example and explain that, will be really helpful.
So I'll give you. So first of all, we have this, as people call it, unfair advantage. There are about 500,000 alumni access that we have across the IIT-IIM ecosystem, and the reason they work very passionately with us is because part of our carry that we make goes back as endowments to the IITs. In fact, I helped IIT Delhi set up its first endowment fund, which is India's first endowment fund, which was launched by the Honorable President at Rashtrapati Bhavan. The message went out very strong that IvyCap is actually giving back to the alma maters, to the ecosystem, and that's the reason alumni of the IITs work very passionately with us. And when we reached out to 75,000 alumni in the first year itself, there were 3 questions we'd asked them, and one of the questions was, would you give us one day of your month for mentorship and guidance? And I can tell you that the kind of response we got, was so phenomenal. The majority of the people who are heading companies or have been entrepreneurs and sold their companies were very willing to come and work with us, and we onboarded almost about 5,000 people, with about 60 people as the core mentors who actually, expressed interest to actually give a lot more time and work with us in almost every portfolio company that we are working on right now. I'll give you a few examples. Let's look at Lecture Dental Labs and Clovia. These are 2 interesting companies. In Clovia, which was a lingerie company, we invested in 2015 with a 15 crore investment. We took a 30% stake in the company. We, from our philosophy perspective, we'd done the top down and bottoms up, but nobody in our team had lingerie experience or experience, this kind of a business. So Ravi Dhariwal, who's the former CEO of Times of India, and also he built Pepsi in India. He knew exactly the kind of game that needs to be played. So he came in on board as a mentor. We also onboarded Sharon Turney through our IIT alumni ecosystem itself, who was the CEO and president of Victoria's Secret for 15 years in the US. So she came on board very passionately because she loved our model and started coaching and guiding the entrepreneurs, the founders, in terms of how to build the brand, how to manage your inventory, how to source better quality raw material, how to position yourself in the market, how to segment the market. She was very passionate about it. And that really helped the company to really solve certain problems faster, which would otherwise take much longer for anybody else to learn. Usually, people, if you don't get this kind of advice early on, you will still learn, but it'll be expensive. You'll have to put more money to keep trying experiments, and it might take longer. So it'll take more capital, it'll take more time. In our case, we were able to sell the company to Reliance last year for 940 crores, when we entered at 50 crore valuation in the company. Another example I'll give you, Lecture Dental Labs. Now, this entrepreneur from Gurgaon actually approached us and said, I'm going to build a hub and spoke model for dental labs, and my model is going to be the US dental lab industry is highly fragmented. It's a huge industry, $10 billion size. The largest dental lab, 500 million. The 10th largest is 30 million. So the gap is so large. Most of the dental labs in the US are 1 million to 10 million size. Very fragmented industry with the potential to create a hub and spoke. I had done something similar with the Piramal Group, where we had acquired path labs or diagnostic labs from 0 to 125 labs in 3 years, and we sold that to SRL for 600 crores. So the model was already tried and tested. So we backed this company with a 25 crore investment in 2014. And today, this company has become the 4th largest dental lab in the US. And the mentors that we picked up for that, there was a guy, of course, there were specific people who were actually experts from the dental lab industry, from the IIT ecosystem. But then there is one guy we picked up through the ecosystem who was the largest supplier to the dental lab industry. So he exactly knew the entire mapping of which are the top 50 dental labs. He knew the founders by their names, by their attitude, by their challenges, by everything. So basically, we didn't have to really, spend time on going into, just doing our own, research and analysis, which have taken us 2 years of time to understand. And with this mentor, we were able to really pinpoint and go directly to those top 10 or 15 that we went and acquired, and then structured deals with them. So that's the reason this company grew so fast and became the top 4 dental lab companies in the US. So these are just 2 examples, and I can go on, and every company that we invested in would have seen something very similar.
This is very interesting. So I would also want to understand from you, like you mentioned, that you have been very patient in figuring out which company to invest in terms of kind of not just I would say waiting for a year, but at times waiting for even 4 or 5 years till the time you're convinced. Now, in that entire journey, because generally startups journey is like very fast paced, you would have missed also some good startups. So what are the learnings, or if you can share some example of a very big miss that you feel regretful about, and why and how was that missed, and what is the learning that you have had from that miss?
Policy Bazaar, Slice, Spinny, then Dehat, we had discussions very early stages with them. Policy Bazaar for a 50 lakh investment, Dehat for a 15-20 crore investment at valuations which are, the delta was very small at the time when we were looking at the valuations in these companies. But we stuck to our principles, and again, same point, if you go retrospect, will I change my view on this, on our approach, and would we have done it differently? The answer is no, and I'll tell you why. For us in Fund 1, we invested in only 10 companies, right? And Fund 2 invested in only 15 new companies plus 8 follow-ons, total 23 companies. In Fund 3, we're investing only 25. So the point I'm trying to make is that for us, the risk of losing out is not a risk we consider, because we are not driven by a FOMO. The majority of the angel investors do get driven by a FOMO kind of a thing, that if you don't do this, you'll miss it out. And founders are experts in creating a FOMO. So they will always tell you that, guys, I'm closing the round, and if you don't come in, then you come in my next round and all that. I mean, in fact, if a founder comes and tells me that, I have a term sheet and, this is the valuation at which the term sheet is there, my first response is that, why don't you finish those discussions first? And once you're ready to take our money, then let's talk. most of the deals we've done like that. In fact, almost I don't remember any deal where we actually said that no, I mean, we are giving you the term sheet right away. Even in cases where we believed that these founders were actually the ones we really wanted to invest in, we were not driven by FOMO at all. We made sure that they knew what value we can bring to the table. We made sure that they actually valued that, and therefore factored that in terms of accommodating us, rather than telling us this is the room available, take it or leave it. When somebody says take it or leave it, we simply leave it at that time. We just don't even argue. And in that process, yes, we will kind of obviously lose out on deals which will go and become large. We are okay with that, because eventually the ones that we tick mark on everything that we believe makes sense, the ones where it kind of works out in our entire construct, as long as we are able to create a lot of value in those companies, we get returns for our investors. So, but we have created a pool, small pool now with a separate team, where we have actually, because now we can afford to take slightly more risks now that we have proven fund 1, fund 2 we have already delivered. Fund 3, we've allocated 5% of the fund, which is 100 crores for seed stage investments, primarily because we do realize that some of these deals do move very fast, and there we need a foot into the door. And we know that some of these things we would have missed out only because we didn't get an entry early, even though they came to us very early. We just not doing seed stage at that time, and later on somebody else did series A because somebody had invested in them already. So for us, series A is still the passion, but the seed stage we will do with that intent that will bring series A capital. So with the 100 crore, we'll probably do 25, 30 companies, maybe a little bit more, depending on how many we are able to do per, or how much we are able to do per company. But that's a separate team, separate mindset, separate approach. With our IvyCap platform, which is actually an engagement platform, we are curating 6,000 startups to that platform. We have corporate engagement, incubation engagement, and IIT and IM engagement, where we are able to spot these very early stage startups. And there, the mandate is that as long as they tick mark on the basic things of the founders and it really doesn't matter what the terms are. What matters is that we have the foot into the door. So that approach we're following as part of the fund, so that we can really scale up companies as they scale up over time.
Sure, Vikram. So we come to the last part of this very interesting webinar. So if you were to again, become an entrepreneur, you have had so much experience of having dealt with so many entrepreneurs across sectors, across business models. How will you, approach maybe creating a unicorn, and what are the kind of, I would say, uh, steps that you will follow to create a unicorn?
So I consider myself an entrepreneur anyways, right? I mean, I started IvyCap and I had zero money in my bank. I had no team at that time. And one thing I knew that I had to do it. I was very clear in terms of what problem I'm solving, what I'm building. And that vision continues from that time, that IvyCap will become the largest homegrown venture capital fund, which will be largest globally from India. So that's the path we are on. And, so it's a similar story that any unicorn founder will go through. I mean, as long as you're clear on, again, the why part, why you're doing it, what and how are very visible. Why is not very visible, so why needs to be understood very well. So I think the fundamental aspect of this is the real conviction, the real motivation, and of course the ability to select the right people and structure the right motivation structure for everyone. So many times you build a team, but you're not able to structure the right risk reward ratio for the team. So you tend to lose good quality people if you're not incentivized enough, and you tend to gain bad people, who don't deliver or don't align with your thought process. If you actually structure it differently. So I think the ability to identify the right people upfront when you're building your company, the ability to incentivize them properly and align their vision with your vision, so that they also feel the same pain and the gain in the whole story. It's not easy, and it's you have to build it in such a way that you meet with lots of people. Plus, I tell one thing to all the entrepreneurs is that don't take the first check that comes your way. In fact, take every rejection as an important step, because by the time you have 10 rejections, the 11th meeting you will be more knowledgeable than the investor themselves, because the questions that you would have faced in the previous 10 meetings would have made you more intelligent than the 11th investor you're going to meet. So my advice to the founders is always, keep meeting as many investors as you want, or as many investors that are there in the market. Learn about them, learn about the investing style, and make sure that you partner with the ones you think you align with in terms of long-term objectives, rather than the one who's giving you the highest valuation. Because there are people who would be sitting with the pressure to deploy capital and may not know anything about your business and may have other pressures to exit their money, and they'll just somehow uh, destroy your plan over time, and you will suddenly find yourself at a point where you don't know what to do now. So therefore, it's important to get the right people, whether it is your building of team or investors. So that's something which is extremely important.
Sure, Vikram. I think this is really very, very insightful, and we have kind of come to the end of this webinar. And one final word with regards to your fund that you are raising currently. You have already raised 90% of your fund. We are kind of quite aware of that. But at the same time, here onwards, what are the future plans that you have with regards to further fundraise? Will you be managing this fund, which is the largest fund currently that you have raised, for some time, and then come up with the next fundraise, or parallel you're thinking of raising another fund also?
So 70% of our fundraise so far is institutional capital. We have 25 Indian institutions, the largest banks, insurance companies, government of India, through different pockets. And 20% of our funds are from IIT alumni. Remaining 10% are actually from the various family offices, ultra HNIs. And almost 65%, 2/3 of our capital actually come from the investors who were investors in the previous fund. Fund 1, Fund 2, they actually increased their commitment over time. So very fortunate in that sense. In fact, people tell us that we have become the largest homegrown domestic venture capital fund in terms of the size of the assets. And we are very close to the final closing now. We've already deployed more than 1/4 of the fund now. And the idea is to really make sure that we stabilize, and watch this portfolio for at least some time. We have a very, very good team, about 16 people in the investment team right now. We are further strengthening it, overall 40 people team. And we are kind of course, there is a lot of interest we see from investors who are already talking about their next fund and where they want to invest in the next fund. But I think we'll probably give it some time, at least 6 to 8 months before we start working on the next fund.
Vikram, we have been doing these webinars every Friday, and we started this rhythm during COVID times, and we would have done I would say more than 100 such episodes. It is really insightful and interesting to learn from every fund manager, and we generally do such discussions with the fund managers who talk about stock market in general, which is like the part of listed space, but you belong to the space of unlisted investments. But it will be interesting to know your view on way forward with regards to, in general, India's economy and sectors where you see kind of a lot of growth happening.
So yeah, I think we all know that the next phase of growth is going to happen through sustainable business development, or the SDG, Sustainable Development Goals, SDG framework kind of development aspect, where ESG is going to become even more important. We have a team of about 5 people who are actually very focused on evaluating every company from an SDG lens perspective. And therefore, any businesses which are looking at the climate side, looking at the environment side are going to get more and more prominence. And existing businesses, even if they're not directly environment focused, if they're following practices which are related to cleaner environment and better environment, I think they will get more and more attention. Use of technology is going to become even more deep. You will see more deep tech. Any business which is able to leverage more and more data, and any AI tools also. Any AI tool is as intelligent as the quality of data it processes. So therefore, any businesses which can produce volumes of data and process that volumes of data. So businesses like financial services, insurance, healthcare, biotech, many of these businesses you will see processing humongous amount of data, and you will see AI applications getting more and more value creating products you will see in this space. And then you will see new age kinds of businesses, anything to do with the clean tech or EVs, or again impacting the environment directly or indirectly, where you will see multiple models emerging. And again, some of these will be capital intensive, some of these will be very capital efficient, and things which are also bridging the gap from the wherever the infrastructure is broken. For example, Celsius, one of our companies which is actually focused on cold chain logistics, something which has been neglected for years and years, and I think the time has come for somebody to really take it on as a challenge. And this company has done that, and doing it very, very effectively with a lot of capital efficiency. So you will see such businesses as well, which are able to bridge infrastructural gaps, whether it's in logistics or otherwise, also playing a huge role in the next phase of growth. So these are just a few examples, and of course, India, if you're adding $300 billion plus every year, you're creating another India in next 10 years. The 2x of our current GDP happening in that time frame. The opportunity lies for everyone.
Vikram, thank you so much for your time today, and thank you everyone for joining for this very interesting and very insightful webinar. We'll be again back with another webinar on next Friday. Absolutely, this has been really, really insightful and interesting conversing with you. Once again, thank you so much, Vikram, for your time.
Thank you, Kamal. Really appreciate it. Thank you so much.
Pleasure.
Bye-bye.